What's up, crew? Neil again, and welcome back to the Energy Academy. In this episode, I'll be taking a look at the forward market from a new angle, talking about the difference between physical and non-physical trading. As explained in the previous episode, forward trading just refers to contracts between two parties to buy and sell electricity at a set price on a future date. In a physical trade, the seller or generator agrees to sell power to the buyer or supplier in advance of delivery. The asset then generates the power when it should, as per the terms of the agreement. Let's first look at a physical trade. The buyer purchases 100 megawatts of electricity for delivery in Ether Block 5 in a month's time. The seller then delivers this as agreed. The electrons move along the cables and have been physically traded. As I mentioned before, a lot of the time these contracts are to reduce risk. However, sometimes businesses or traders enter into forward contracts speculatively. This might sound fancy, but it essentially just means making a bet on how the price will change. The idea here is to make money from that bet rather than wanting to buy or sell actual electricity. Since forwards are only paper contracts and not physical commodities, it means that businesses can trade the contracts without ever actually needing to deliver any electricity. When this happens, it's called non-physical trading. To help explain this better, I'll outline a couple of simple non-physical trading scenarios. In the first scenario, the trader buys an electricity forward contract and speculates or bets that the price of electricity will increase in the intervening period before delivery. In this example, the buyer purchases 100 megawatts of electricity for delivery across the evening peak, Ether Block 5, in a month's time. In this scenario, the trader is imitating a supplier. However, the buyer's not a supplier at all. It's a non-physical trader. The trader has no intention of actually supplying electricity to customers. As I said, they're expecting the price of electricity to increase closer to real time. So, let's say they buy that electricity at £50 per megawatt hour. If the electricity rises in the intervening period to, let's say, £75 a megawatt hour, the trader can then sell on that contract to an actual supplier who actually needs it to meet their customers' demands. The trader has made a profit, £25 per megawatt hour, without actually having to deliver any electricity to customers. Crucially, they need to sell this electricity before the time of delivery. Otherwise, they're obliged to actually buy the electricity from a generator. So, if the price instead goes down to £40 per megawatt hour, the trader still has to sell that contract. However, as they can only get £40 a megawatt hour for it, in this case the trader makes a loss of £10 per megawatt hour. Let's look at non-physical trading from another angle. In this scenario, the non-physical trader is imitating a generator, i.e. a seller of electricity. The trader enters into a contract to sell electricity to a supplier. Again, let's say 100 megawatts across Ether Block 5 in a month's time. This time, the contract is worth £100 per megawatt hour. In this scenario, the trader expects the price of electricity to fall in the intervening period before delivery. And let's say it does, to £75 per megawatt hour. The trader then goes to an actual generator who buys that contract to deliver electricity. The supplier, the buyer, still has to pay the £100 per megawatt hour it agreed, but the going rate for electricity is now £75 per megawatt hour. In this case, the generator pays the non-physical trader the difference, the £25 per megawatt hour, which is the trader's profit. Again, the trader needs to find a generator to buy this contract before the time of delivery. Otherwise, they're obliged to generate the power that they agreed to or face penalties if they're unable to. Just to be clear, these are massively oversimplified scenarios. Non-physical trading is usually far more complex than this. You might get true non-physical traders who basically buy and sell contracts without ever planning to deliver or purchase any electricity, and this puts the trader at significant risk. They could be forced to buy or sell those contracts at a loss if prices were to change in the opposite direction that they expected them to. Alternatively, they could face penalties for not delivering on their contracts. However, you can also find asset-backed non-physical traders. These are generators who have the ability to deliver on their contracts, but may enter into non-physical trades when an opportunity for profit arises. Due to the ability to actually generate the power necessary, this comes with less risk. Anyway, now you know how over-the-counter forward trading works, you know the timings of the E for day, and you know what non-physical trading means. It's time for us to have a look at another aspect of the wholesale market, exchange trading. I'll see you on the next episode.